I have to say that I just realized this morning that I've been doing ECB watching since the ECB started, really, because in 1999 I happened to be still at the IMF in the European department. Then I moved to the private sector and I've been doing ECB watching since then. So I think I have like 16 years of ECB watching with me. I think the summary of what I want to say is that we have QE finally. And finally in the sense that I think some of us have been arguing that at least this is more of a year too late. But we are saying it's more than a year too late, because at least my own view was that the ECB was failing its price stability mandate. If you were defining their price stability mandate as inflation at 2% in the medium term, not close but below, but 2. And the reason I was using 2 is that for many years of listening to Jean-Claude Trichet and many other officials of the ECB, they were claiming that they were very, very proud of their price stability record, because inflation since their mandate had averaged 2.0. And so essentially I was really taking them at face value and thinking that they were like the other central banks, and even if in writing it was saying close but below, the reality was 2. Now what we saw is that the reality wasn't 2 when it came to the downside. And one can make the point that perhaps there has been a dangerous allowing of second round effects to the downside to develop, to get to a point where inflation expectations may have got a little bit too risky to get an anchor to the downside. But the good news is that there has been a reaction. We have QE. I think it's most welcome, it's well designed. In the paper that Adam mentioned, I was arguing that it should be large, it should be open-ended, and it should be conditional on the inflation outlook. And I think we got all 3. I think it was clear from the presentation this morning by President Rosengreen that QE works essentially when it sells an insurance on the inflation outlook. That's why QE3 worked, QE2 didn't, because we are talking about different things. If I can use the third language, it's goal-oriented monetary policy. And that's, I think, what we got from the ECB. Now, I disagree with those many out there who says it's not going to work. I think it will. The channels, I think, are quite clear. We have a signaling effect. If you look at market prices, the market assumes no rate increases until at least March of 2018. And I would assume the reality is that the market is assuming even longer, but the way markets price just show that. My own assumption is that the ECB is not going to raise rates until next decade, essentially. It's going to work via confidence. It's quite important that the ECB is going to do QE, because the ECB is finally becoming a normal central bank. A normal central bank that can use quantitative easing. And I think this has been a struggle. There are political issues that have perhaps delayed this process. But I think it's quite positive and quite important that this is happening, because once it's used once, it can be used forever. And it is very important that the ECB feels that QE is just another tool in their structure. It's going to work via portfolio rebalancing. If you look at periphery bonds, yes, yields are low, but they are still positive in real terms. So you can still have a decline of those yields. Probably this requires some ratings actions, by the way, so non-Eurozone investors can become more comfortable buying some of these bonds, but that eventually should come. It should also work through European equities and other assets, as there is still a large risk premium in those assets, and the operation of QE should remove some of this risk premium, which may be associated with the risk of inflation, by the way. I think it will work because of the economics. I see the euro area a bit like the US in 2010. So you just finished the bank recapitalization. There are no more doubts about the solvency of the banks. Growth has essentially stabilized, started to pick up. And QE is working with the trend, not against. And that is quite important. So you are coming essentially pushing on a bit of an open door rather than against the wind. There is also a more balanced policy mix, thanks in part to the efforts of some of us, as Anna was arguing, that there is a bit of a need for more demand support, or at least a more balanced policy mix between demand and reforms. And the banking union should also improve the transmission mechanism of policy, right? Because to some extent, the barriers to intra-euro area liquidity flows have been lowered, or should be lowering over time, thanks to the banking union and thanks to the work of the supervisors. So when I put all of these things together, I think there are reasons to believe that this can be a successful enterprise. Now, when you look at market pricing and market reaction, we can sort of run a sort of Mickey Mouse exercise similar to the ones that were done for the Fed in terms of an event study. So what have markets done after the ECB has announced the quantitative easing program? And the answer is we are sort of halfway there. Long-term real rates have declined, but they still can decline more. If you look at the GDP-weighted basket of 10-year rates in the euro area, inflated by 10-year inflation rates, is at around 0. In the US it went to -1%, in the UK to -2. There is still room for those real yields to fall, probably more via higher inflation expectations and lower nominal yields, but there is room on both. Then if you look at inflation break-evens, which Peter was mentioning, it's true there are imperfect measures, but they are an important measure. So this is what has happened, which is quite interesting. Until ECB was launched, you have an inflation curve, if you look at inflation swaps, that was very flat, with the endpoint, if you look at the term structure of inflation on 1 year forward, 1 year, 2 year forwards, and so on, that was sort of ending at around 175. But it was very flat. It was assuming inflation below 1% for the first 5 years, which essentially was signaling that markets were expecting that the deflation risk was non-negligible in the next few years. Now, after the announcement of QE, that front end of the inflation curve has moved up. So when you look at the 1 year inflation 4 years forward, for example, to take one where the oil prices and other things should no longer be part of the process, has moved up from 1 to 1.5%. That's good news. The bad news is that the long end of the curve hasn't moved. And so it moved a little bit from like a 1 year rate, 9 years forward. It moved from 175 to around 2%, but it's back to 175. So what is the market telling us? The market is telling us, so far so good, but we still need to see the money. We need to see how QE operates. We need to see that you are going to do it the right way. We need to see that communication is going to be convincing, that there are not going to be issues, bickering, disagreements, and that the sentence that says we will continue to do it until the path of inflation is the right one, it's true. So I think the ECB still needs to buy credibility with actions as far as the market pricing is concerned. It's quite interesting. If you look at the inflation swap curves across countries, you can compare the US, the euro area, the UK, Sweden, Australia, and Japan. Those are the ones for which you find data. And you find that in all of the cases, the inflation curves have declined. So this is a global phenomenon. But for the euro area, it has declined more.